Dear friends, we are discussing Section 17 of CGST Act 2017, apportionment of credit and blocked credit. Section 17 consists of 6 subsections. We are mainly discussing or mainly focusing on rule number 42 of CGST rules. Subsection 1 of Section 17 talks about where the goods or service or both are used by the registered person partly for the purpose of business or partly for other purpose, then input tax credit shall be restricted to so much of input tax as is attributable to the purpose of his business. So if the person is using the goods or service or both for the purpose of business and any other purpose, then input tax credit is restricted to so much of the input tax as is attributable to the for the purpose of his business. And the subsection 2 talks about goods or services or both are used by the registered person partly for the affecting taxable supplies including zero rated supplies and partly for the affecting exempted supplies under the said act, then input tax is restricted to so much of the input tax as is attributable to the said taxable supplies including zero rated supplies. The example of zero rated supplies are export of supplies. So export of supplies will come under zero rated supplies. So here a registered person used the goods, service or both for the purpose of supplying taxable supplies and exempted supplies. Then also input tax credit is restricted to so much of the input tax as is attributable to the said taxable supplies including zero rated supply. Subsection 3 of the Section 17 talks about the value of exempted supplies. Under subsection 2 shall be such as may be prescribed. The prescribed manner is nil rated supplies, the whole exempt supplies and non-taxable supplies. These three are the prescribed manner of this prescribed list of exempted supplies and shall includes not only these three and shall include supplies on which the recipient is liable to pay under the reverse charge mechanism. So if the recipient is payable tax under reverse charge mechanism, that will be also considered as exempted supplies. And transaction in securities will be considered exempted supplies and sale of land, but subject to clause B of paragraph 5 of schedule 2 sale of building. That has to be considered while considering sale of land. Subsection 4 of section 17 talks about a banking company or financial institution including a non-banking financial company engaged in supply of services and by way of accepting deposit, extending loans or advances shall have an option. They have an option to either comply with the provisions of subsection 2. So what is subsection 2? Subsection 2 is here the input tax credit shall be restricted so much of the input tax as is attributable to the said taxable supplies. That is one option available to the banking companies, or avail every month amount of equal to 50% of the eligible input tax credit on input capital goods and input services in that month, and the rest or shall be lapsed. So for example, if the banking company has an input tax of 50,000, then here we will be applying 50%. The remaining 25,000 will be considered as eligible amount, and the remaining amount of 25,000 will be lapsed for the period of said the period of option exercised. But there are two conditions in respect to the options available to the banking companies. The first option is, or first condition is, once option is exercised shall not be withdrawn during the remaining part of the financial year. That is first condition. The other condition is restriction of the 50% shall not apply to the tax paid. The 50% restriction is not applicable to the output tax paid. It's only restricted to the input tax. Now we come to the subsection 5 of the subsection 5 of section 17. Here there are some list of input tax credit which will be blocked to the supplier. Subsection 6 of section 17 talks about the government may be prescribed a manner in which the credit referred to the subsection 1 and subsection 2 may be attributed. So subsection 1 and these two, in case of these two supplier, there is a manner of determination of input tax credit, and there is some other computation that will be prescribed under rule number 42 and 43. So 42 and 43 talks about the manner of description of manner of determination of reversal of input tax credit in respect to inputs or input services. Rule number 43 talks about reversal of input tax credit in respect of capital goods. So we are mainly highlighting the rule number 42 here with an example. So rule number 42, there will be a consist of ineligible ITC and ITC available. So we can take it as total input tax credit as T. This one is equal to input tax credit available and input tax ineligible input tax credit, that can be categorized in these two. Then here it is one, here is the other part. Under this ineligible ITC, this can be directly, we can consider it as not available. So what are the three categories under ineligible ITC? The first one is inputs exclusively for the non-business, that shall be reduced from the total tax. Second one is T2, input tax exclusively for the exempted supplies, that will also reduce from the total input tax available. These two will be shown under our GSTR 3B table 4 of D2 of GSTR 3B. This one also will be showing under table 4 D2 of GSTR 3B. And the third one is input tax credit, which are listed under section 17 subsection 5, which means it's a blocked credit. The blocked credit will be also reduced from the total input tax, and it shall be shown under table 4 D1 of GSTR 3B. The other part of the ITC available is C1, that can be considered as C1. The C1 will be here it is C1. C1 will be consist of T4 and C2. So what is T4? T4 are very simple, inputs exclusively for the taxable supplies. So inputs exclusively for the taxable supply. In that case, the entire ITC can be eligible for input tax credit, that can be taken, and the remaining part is common credit. Under common credit, what all are reduced or reversed as D1 and D2. These two can be reduced, and the remaining part of C3 can be taken as input tax credit, and this is eligible common credit, it is eligible input tax credit. This will be considered under GSTR 3B table 4A5 of GSTR 3B. Now comes under D1 and D2. What is the calculation for the purpose of getting D1 and D2? So what is D1? If the supply is used for the partially personal purpose, if the input tax credit is used, common credit is available, which is used for the partially personal and partially exempted, then there is a calculation. The calculation is application of percentage of turnover of C2, that is for the calculation of D1, and the other one is D2. D2 is the just a simple application of 5% of C2, that will be considered partially personal expense. For the D1 calculation, we have to apply the percentage of turnover of C2. So here it is how. So D1 is equal to C2 multiplied by C divided by E, F. So C2 multiplied by E divided by F. So E is equal to aggregate value of exempted supplies during the tax period and total turnover of the registered person during the tax period. That is the computation. So we can just take an example of 1 lakh rupees input tax credit is there. for the entire period of April 2022. Under this, we can just categorize into eligible and ineligible ITCs. So here, inputs are exclusively used for the non-business purpose. Then it is ineligible ITC that has to be reduced. Inputs exclusively for the exempted supplies, that is also will come under T2 ineligible ITC, that shall also reduce 5,000. Again, blocked credit under section 17 subsection 5, that is 2,500, that is also required to reduced. So these three amount has to be reduced, and the remaining thing is first one is exclusively for the taxable supply, that we can get at the end of the calculation. Here it is the common credit. What shall do for the common credit? For the common credit, we have to categorize D1 and D2. Under D2, it is very easy. 5% of the common credit can be considered as ITC reversal. So here it is a common credit of 45,000. 45,000 multiplied by 5%, it will be 2,250. This can be reduced. It will be reversed under rule number 42. This one also we can just reduce. The other one is input tax credit, which are partially exempted supplies. So there is a separate calculation for this. This calculation will be calculated on the basis of exempted supply of service or exempted supplies for the period and aggregate turnover of the total period. Here it comes. So common credit is 45,000. So 45,000 will be multiplied by what is the exempted supply for the period. The exempted supply for the period is 5 lakh rupees divided by how much? 15 lakh. The total turnover for the period is 15 lakh is equal to how much? It will be 15,000. This 15,000 will be revised under rule number 42. So our total input tax credit will be available as per rule number 42. After reversal of the input tax credit under rule number 42 is 1 lakh rupees. Our total input tax credit. Here we have to reduce 10,000, 5,000, 2,500 in the ITC reversed. How we get the 15,000? It is an application of E divided by F and 2,500, 2,250 rupees as a personal common credit. So we will be reducing 34,750 is equal to 65,250. This is how we will be calculating input tax credit eligibility under rule number 42. At the end of the financial year, we will be calculating the finalization of the input tax credit reversal. If the final input tax credit reversal is excess of the provisional credit, then we have to repay the input tax credit reversal with an 18% from the date of April of next year till the date of payment. So how it will be calculated? So for the previous year, for the current year, we will be calculating input tax credit reversal on provisional basis with respect to each month. So at the end of the year, we will get the actual exempted supplies, actual turnover for the whole year. For the whole year, we will be calculating the input tax credit, exempted supplies and total turnover. Then after that, if we get the final credit is 7 lakh rupees for the entire financial year 2021 and 22, and we have shown only 4 lakh rupees as financial year 21-22 as a provisional. Then here it comes the adjustment. Then the difference of 3 lakh rupees shall be paid with an interest of 18% from April of next year till the date of payment. That has to be paid by the 20th of October of next financial year. That is the adjustment has to be done in case of final input tax credit reversal is excess of provisional credit. And in case of input tax credit or final input tax credit is less than the provisional credit which we have reduced, then that time the excess amount will be credited to our electronic credit ledger. No interest will be available for us. So for say, if the input tax credit is, the final input tax credit is 7 lakh, and we have already considered the provisional credit for rupees 8 lakh for the financial year 21-22, then 1 lakh rupees will be credited to our electronic credit ledger without any interest receivable. Okay, that adjustment has to be done at the end of the financial year. Thank you so much.